Life with us because she was already starting to make me feel better about the economy.
Good.
So she can calm down our jitters and give us some practical, good advice.
Take some notes.
So I think we're going to wait a few more minutes, right, Alexandra? Uh, should should
You
we
can get
start?
started if you want. We're
Okay,
about five.
okay. Well, good afternoon.
I'm sorry. Gotta get
Good afternoon, everyone. I'm Michelle Wolf, Executive Director of JLA Trust, joined today by our Director of Marketing and Outreach, Alexandra Oatman, and our special guest is Jennifer Joseph. So we want to spend most of the time letting Jennifer share her expertise and answer your questions. So I'm not going to really be presenting at all today, but there'll be other opportunities if you want to know more about JLA Trust. So, Jennifer is part of the Money Management Educators Financial Network. She is a liaison to New York Life corporate clients, which are among the country's leading companies. And she's also a full time registered representative offering financial services. And she mostly works in the Southern California area. So, I will turn it over to Jennifer.
Thank you so much, Michelle, and thank you, Alexandra, and thank you so much for all to join and taking your time today to join me and listen to the seminar. So I'm gonna go ahead and start sharing my screen. Um, just want to make sure it looks, push this to the front, that it looks okay. Once it looks okay, I'll get started. Okay. Look okay. There's no excess, any notes on the side. You guys can't see any of that. You just can see the presentation. All good? Perfect. Um, so yes, the title of today's presentation is the Foundations for Your Financial Future. So we'll be talking about specific concepts to make sure you're doing the right things to prepare for any goals you may have, or retirement or anything of that nature. And this is going to be, I like to keep it interactive. So I will stop in certain areas for questions. But if questions do pop up, feel free to use the raise hand uh, function on the Zoom call that is available, right? Michelle and Alexandra, just want to make sure. Okay, perfect. But yes, I will stop and then I will also take questions at the end as well. So yeah, I don't want, I would like to keep it, interactive, and then there'll be like trivia questions in the presentation as well. So that will be a little, exciting. So yes, but before any of that exciting stuff, we are obliged to provide a disclosure. So this is essentially saying that the information discussed here, isn't specific advice for you as the listener. You should consult your professionals for, any further advice. So that is the main disclosure here. And then okay, I think I need to make this bigger. Oops. There we go. Okay. Like Michelle introduced, I'm an educator with Money Management Educators. My name is Jennifer Joseph, and I'm also a liaison with New York Life, like she mentioned. So I'm also a registered representative and financial advisor with New York Life. So that's like a small intro on me and a nice little picture of me. So this presentation, what are we going to talk about? What are the topics that are going to be covered? So right here are the four main topics that we're going to cover in detail today. So the first topic we're covering is budgeting and credit. So how can you budget and credit to make sure your income or your expenses are managed based off of your income and how you can live within your means, pay off debt, save money, and build your financial future. The next topic we'll be talking about is protection. So how to protect your family in case something unexpected happens. So health, accidents, disability, financial uncertainty, all of that. How do you protect you and your family against that? The third topic is macro balance strategy. Something maybe, something that you may not have come across, but essentially what that means is when you're growing your assets, how do you create a balanced portfolio? It's very simple. That's all. It's a fancy name for a balanced portfolio. And we'll dig into how you have to balance it in terms of risk, but also in terms of taxes. As you have, probably noticed in the news with the tariffs, and we don't have a tax plan for next year. Your strategy for taxes is very, very important, especially in this time. And then the last topic we'll talk about, which is also very relevant to the time we're living in, is avoiding market pitfalls. So how to properly, diversify your market portfolio so that you're growing your wealth over time and not, worsening your losses or, anything like that. So that's the final topic we'll cover. And you've probably seen how how the stock market, it's very, very relevant to what we are dealing with today. So those are the four topics. I do want to, before we get into the first topic, I do want to bring this little visual out. Um, Essentially, a good financial strategy, we compare it to a house. So you do need all aspects of this house to have a good financial portfolio. And like any house, you start with the foundation. That's the protection, which we'll be talking about in the first two sections. The house cell itself is the accumulation. So what that will be the second two topics. So how are you building your wealth and what is it invested in? And the last, the roof is the preservation and your legacy. So how are you taking that money out in retirement? How are you using it? How is it taxed, which is very, very important? And what are you leaving behind for your next of kin? So what is your legacy? So this is all aspects of this should be, you know, uh, taken care of to have a full financial portfolio. And to start, we'll start with budgeting and crediting, or sorry, budgeting and crediting, budgeting and credit, and that will essentially fall in the protection category. So some people believe budgeting may feel restrictive. Some people may feel it empowering, but I'm here to say budgeting does give you more power. And the reason being is you are designating what you spend your money on rather than, oh, I don't know what comes in, I don't know what goes out. Like I just kind of do it. You are like, this money is going towards this. This is going towards that. So you're taking the power to, put money where you want it to be. Now, having said that, a good budget, the first rule of personal finance is don't spend money you don't have. The second rule is you should pay yourself first, always. So, what you bring in, uh, aggressive saving strategy is 20%. But at minimum should be 10%. So you should be putting at least 10% into some sort of savings vehicle. So that's how you're paying yourself first. Now, a little bit more aggressive and recommended is 20%. So once you have your savings taken care of, you have your other aspects of your budgeting. So that usually 50% should be needs. So this is, your home payments, housing, food, any other expenses that you absolutely need to, for your living. The 30%, that can go up and down the wants, so that's all discretionary. So if you want to increase your savings based off of your goals, or if your needs are a little bit more, that discretionary spending can, be adjusted. But, that 30% is a, recommended number. So that's where, you're budgeting, this is a healthy budget to plan for your financial goals. And that kind of takes me into the next topic, which is the credit scores and what it does for you. So really, the point of credit is to afford something or to purchase something that you don't have the assets for right now, but you're, taking out a loan for it so that you can build your wealth or anything in the future. So that's where the credit score comes. A good credit score is usually over 670. 800 is amazing, excellent. So the higher you go, the better rates you'll get, interest rates, all that. Um, but another question that people ask is, how is my credit score calculated? It's it's right here. The percentage of what they use. So the biggest percentage of how your score is calculated is payment history. That's 35%. Next category is amounts owed, 30%. And after that is length of credit history. Then you have credit mix and new credit. So the biggest thing to help your credit score is to make sure you're paying everything on time. If you need to put it on auto pay, anything like that, that is the biggest chunk of what creates your credit score. And then credit history is good too. So the longer you have credit, you use credit cards, pay bills, all that, that actually works in your favor as well. So those are like the big areas that you can do to improve your credit score. This is a little financial checkup, and I'll stop for some questions here. But just a little, tip. You should check your credit report, and if there's anything wrong on it, anything erroneous, you should definitely dispute it. And you can also sign up for any credit watching services. Most of them are complimentary, but there are certain that you can pay for. But you do want to make sure your credit is correct. There's nothing wrong on it, and someone else isn't using it or anything like that. It is very, very common nowadays. So just something to keep in mind. I will stop here for a couple questions. Any questions on any of the things that I covered so far? No?
Jennifer, I have a question.
Uh-huh.
So I know we're only supposed to use 50% of our budget for housing and food, but housing is so expensive in Southern California. So a
Mm-hmm.
lot of people end up with more than 50%,
Mm-hmm. Mm-hmm.
especially if they're renting. What do you suggest in that case?
So, usually, I think now it's about 60 to 70%, I think is the normal for housing and food. It is on the higher end, especially with the interest rates. Hopefully, the interest rates do go down in the next 2 years. That is that is the hope that will bring it down. But essentially, then your discretionary will have to reduce. Your discretionary expense will have to reduce. And then the savings, more aggressive saving is 20%, but if you can at least do the minimum of 10%, it will give you more space for the housing and food category as well. Yeah, yeah. I think there's a question in the chat, right? Okay, so what are some credit watching services out there that are legit or budgeting resources? So there's a few. That's something I can actually send in the like end of seminar follow-up. If Alexandra, you want to send it out as resources, I'll definitely send that out along with some other resources. All right. Any other questions? Okay, I will go ahead and move to the next slide. Okay. So one last thing about debt before we go into protection is what are you taking debt out on? So there's essentially three factors. The first thing is, what am I borrowing against? So if it's something that's appreciating in value, then essentially it is a good debt. If it's something that's depreciating in value, like a car, you just want to make sure you're not paying for it longer than its usable time. So, for example, say you buy a car, usually a usable time for a car is 6 to 7 years. That's just average. So, if you're paying for the loan as long as that or longer than that, then essentially the debt is not working for you, it's working against you. But of course, a house that will appreciate. So if you do normally now, 30-year mortgage is very common. It's an appreciating asset, so it will work for you. The next thing is the interest rate. If you have a high interest rate, you can potentially bring it down when it comes to mortgages, refinancing, car payments. There are options to bring it down. That would be, something you can speak to with your the person who has your car loan. And then the last thing is, uh, do, are your debt payments making up a lot of your monthly spending? So if that's the case, you do want to pay off your high debt items first, and then focus on your low debt. Or sorry, high debt. You want to pay off your high interest debt first, because that is what's snowballing because of the interest, and then focus on your low interest. So make more payments to your high interest and maybe do minimum for a while on your low interest, and then slowly get rid of all of that. So that would be the strategy, because you don't want to put all your monthly spending into just paying like credit card debt or car payments or anything like that. So that's where that comes in. So the next the next topic we'll be covering is protection. So, like we said in the house, protection is how to protect your family in terms of if something happens to you, health wise, disability, anything like that. So these are the three areas. One is a rainy day fund, so your emergency savings. The second thing is your legal protection. So that's where your wills, trusts, and titling comes in, and then your power of attorneys. And then the last thing is insurance coverage. So we'll be going a little bit into depth into each section in this section here. So the first thing is emergency savings, and a general rule of thumb is you should have 4 to 6 months of your living expenses, your mandatory living expenses, in a fully liquid account. So here are some examples of fully liquid accounts. You have your checking and savings account, money market, life insurance cash values. I'll kind of go into that a little bit later in this section. CDs, if they have a very small lock-in period. So these are essentially, if something happens, loss of a job, loss of income, anything, you will be okay for a certain period of time. So that's the first part of, your protection. And just an FYI, you can borrow from a 401k or take out of an IRA, Roth or a traditional, but you just have to know that if you borrow from a 401k, you do have to pay it back with interest within a certain period of time. So that will be laid out when you take out the loan. And then if you do take out from an IRA or a Roth IRA before 59 and a half, there is a 10% penalty. And then the traditional IRA, you do have to pay the tax as well. So that is like a last resort. You do have that option, but you just have to make sure you're aware of the limitations. The next part of the protection is the legal protection. So what do I have set up for me in case something happens and my assets are properly transferred to my next of kin or whoever I want it to be? It could be a charity, next of kin, anybody. So The basic estate planning is your will, your trust, and beneficiary designation on all your accounts. So a will tell you where the assets will go to after you pass away. The trust, essentially what that does is it will, without your next of kin having to go to probate, transfer property to their name. Because essentially, once you pass away, the trust will essentially dictate who gets any property or anything like that. Because if you don't have a trust, then your next of kin does have to go to probate, and the state will decide who gets what. And this is most common with property. And then the last thing is any financial accounts that you have. So bank accounts, life insurance, uh, anything of that nature that you can put a beneficiary on, that you do have to make sure those are accurate and up to date, because whoever you have as a beneficiary on your account actually supersedes a will. So even if you write it off to somebody else on the will, if it's not accurate in the account, whoever's on the account will get that money. And then the other parts of the estate planning is the powers of attorney, living will, and healthcare proxy. So power of attorney is very important. So if you're not able to, make financial transactions or anything like that, if you're out of town, out of the country, you are essentially designating somebody to make those transactions and financial decisions for you. Just to keep in mind, there is a durable power of attorney, which is the preferred one, because if you have durable power of attorney, if you are incapacitated, they can still make decisions for you. If you just have the regular power of attorney, if you become incapacitated, they unfortunately can no longer make financial decisions for you. So I do want to make that distinction there. And then the living will is just rules that you set for medical care, what you do and don't want to do. Like this is where do not resuscitate, all that stuff. That's where the living will goes into. And then the healthcare proxy is any medical decisions. You're assigning somebody to make those medical decisions for you. And you want to make sure they know that your wishes will be met. I'm going to do one more slide on home and auto insurance, and then I know there's some questions in the chat, so I will answer those. Just quickly, the other aspect of home and auto, the last aspect of protection is insurance. And the first thing is home and auto insurance, especially with the natural disasters that are happening all over the country. Home insurance is very, very important. Home and renters insurance, very important. You just have to be careful when you're picking your policy, the coverage. If it's renters insurance, the coverage to replace whatever's in the property. And for if you're a homeowner, coverage to rebuild, not the value of the home. So that's something, you should consider before choosing the type of policy. And of course, deductibles. Deductible is something that you pay before the insurance company pays. So if that's too high, that's something you have to take into account in your emergency savings. And just to keep that in mind. Same thing with car insurance. Your coverage should be the value of your car to replace it or to fix it. And then deductibles there too. If you have a large deductible, you have to make sure your emergency expenses are, enough to take care of it. Let me do a little pause here, answer some questions.
Would you recommend consolidating credit card debt?
Consolidating, like putting it into one, one card.
I assume either that or getting one of the loans
Yeah, so credit card debt is just not recommended by any financial advisor. It's just because the interest is so high. So if you are able to get a loan with a smaller interest rate to pay off that credit card debt, it is better to do it that way because you're not paying as much interest. Or if you do have a property, you can refinance it, take some out and pay off the credit card debt, and then you're just paying the loan on your house, which is a much less interest rate than what you're paying for your credit card. So it's never smart to just keep it in credit card. If you can get a lower interest loan, that is the way to go.
We're saving money through CalAble. How can we save more than $100,000 for a house down payment? Can it be put into a trust for future use?
So,
Is that a Michelle question, maybe?
I think so. Yeah.
So Cal Able is a tax advantage savings account that lets people with special needs save money without hurting their eligibility for SSI and Medicaid. But there are caps, so you can only put in annually whatever the IRS gift tax exemption is. So for 2025, that amount is 19,000. So, I guess after 5.5 years in Cal Able, you would have 100,000 for the house down payment. So the big question though is, I mean, it's great to have the down payment, but how are you going to make the monthly mortgage costs and all the other costs that are part of having a house, the property taxes and the home insurance, as Jennifer was just talking about. I guess, Suzanne, or you want to unmute it? I guess the question is, can that money be put into a trust for future use?
Right, like if we're trying to save more than 100,000 for my daughter, let's say to maybe get her a condo or something.
Oh, I see. Oh,
Can
okay.
we save
So
that
yeah,
money?
after 5.5 years, yeah, you could transfer that money into a third party special needs trust.
Okay, wonderful. Thank you.
And can we talk about special needs trust as a beneficiary? Is that maybe another Michelle question?
So yeah, so the special needs trust is typically what they call a testamentary beneficiary, a fancy word meaning after death. So yeah, any of those assets that Jennifer was discussing, uh, both bank accounts and certainly life insurance. Yes, you can name a special needs trust as the beneficiary. Generally, you're going to need the EIN number to do that. They're going to ask you on that change of beneficiary form for EIN number. So that's generally how trusts are identified, not by the beneficiary's social security number. Sandy, did you have any specific questions about that?
Yeah, I was just wondering if there's certain kinds of accounts that it's not a good idea to have a special needs trust as the beneficiary, having to do with possible probate and things like that. I'm not sure about this, but I just have some lingering questions on that.
Well, we used to say that these inherited IRAs they can take some time to pull into a special needs trust. Whereas life insurance, as soon as there's, generally, as soon as there's a death certificate, and right, Jennifer, life insurance gets funded pretty quick.
Yeah,
Okay.
and the reason being is the IRAs, they're a different tax code. So when they do become inherited, it takes some time. There may be some taxes owed, depending on the amount and the situation. So that's why it takes a longer. But life insurance in any situation is the death benefit is always tax free.
Okay, and non-retirement accounts would be better than
Right.
the retirement accounts.
Yeah.
Like a brokerage account, for example,
Right.
or a checking account or savings account, that's what they call POD,
Yes,
payable upon
yes.
death. Yeah,
Yeah,
no, we've had the experience, and it's sad, there's a mom and there's two adult kids. One is neurotypical, one has developmental disabilities. Mom passes away, and then the neurotypical siblings is trying to pull out money, and they
right.
were not named on the account, and that account will be frozen. The
Yeah.
banks, if someone's name is not on the bank account, it doesn't matter, mother, sister, spouse, if their name is not on the account prior to death,
Yeah.
those accounts are frozen, and it can take quite some time to unfreeze them.
Okay. Okay.
So um, that's why that's why actually it's a natural for us to pair with Jennifer, is because we really encourage our families to if it makes sense, to purchase life insurance, because like I said, life insurance, as soon as that death certificate comes in, it's pretty quick.
Hmm. Great. Thank
Um,
you.
And I just wanted to add, Michelle, like I mentioned in the thing, if you don't update your beneficiaries on your bank accounts, anything, but you write it in the will, the whoever's on the account is going to supersede the will. So just that is
Right.
the
Yes.
bank, the financial institution for brokerage accounts, they'll honor whatever they have on file. Life insurance too, they will honor whatever is on file. Now, if that person is gone or anything, then it will go to court. They'll take out a will, all of that, but it will take time. But if there's a name and that person is alive and well, doesn't matter if whatever anything else says, it will go to whatever whoever they have on file. Um, oh yeah, I know Suzanne had a question.
Sorry. Yeah. So if I have a trust that is like my family trust, and upon death, my understanding was everything goes into that. Are my children going to be able to access that if they're named in the trust?
Yes. Do you have a trust plus a pour over will into the trust?
I have a trust, a will, and there was even a drop down special needs
Mm-hmm.
trust attached to the trust, but I'm going to update that too and try and.
Right, right. So the trust, in terms of any properties or anything you have,
Mhm.
can be taken care of. You can put any insurance accounts you have in the trust as well, but just make sure it matches what the institutions have on file too, because that's
Okay.
what they're going to take priority. So just make sure it matches.
Okay. Thank you.
Hmm. Any other questions before we go further? No? Okay. This is just a little nice trivia. I know we've been talking about a lot of heavy stuff. Little nice trivia. According to reports, the this Argentinian football star has the most expensive body part insurance in sports. It's Mr. Lionel Messi with a $900 million policy on his left foot. It's so, and he's now retired from international football. So, in case you guys did not know. All right. So going back into well, we already talked about the home insurance, so I will go into health coverage, long-term care disability, and the life insurance. So health coverage, pretty simple here too. The only thing you just have to worry about in the health coverage is how high your deductible is. Something to keep in mind. So, of course, your higher deductible plans are going to be cheaper, but that deductible does have to come out of pocket. So, they have introduced something called HSA accounts, health saving accounts. Essentially, you can put money into it to pay for this deductible. It is whatever you put into it is a tax deduction. And it is invested, so it's tax, it grows tax deferred. And then if you use it for medical related expenses, it's tax free. Now, it can be actually, this is something they introduced. It can be used as a retirement account. I'm going to put that in quotes. It can be used as a retirement account because if you start pulling out money out of that after 65, um, for non-health related expenses, you no longer have to pay the tax penalty. You just have to pay the tax on the gains, but you don't have to pay the tax penalty. Versus if you take it out before 65, there's a penalty plus any taxes for, not using it for non-medical related expenses. So it's a nice little tax deduction. There are limits to what you can put into it, but if you do have a high deductible plan, something to consider. The other types of insurance for your protection is long-term care insurance and disability insurance. Now, long-term care insurance is a very, very hot topic now in California, just because long-term care expenses have gone up significantly, not just in California, all across the country. And what long-term care insurance is, if those of you who are not familiar, is if you need assisted living, you're not able to perform daily activities at any age, whether you're at home or at a nursing facility, assisted facility, this is the insurance that covers it. And Medicare doesn't cover it, it only covers it for the first 90 days. And that's also if only if the doctor actually specifically sends you to a long-term care facility. That's the only time Medicare covers it for the first 90 days. After that, there's no coverage for this type of care in Medicare. So essentially, when it comes to long-term care insurance, there are two types. One is your traditional, you pay into it until you make a claim, and then when you need it, it will pay out. There's another one, it's a more popular one, especially it's like a hybrid. You only pay into it for a certain period of time. And then if you don't see yourself using it, or if you're like, I just want to cash out and walk, you can cash out and walk out of it with like a little bit of interest. So at least you get like a little bit of money back. So those are the two types of long-term care insurance that are available. But it is very, very important to have it or see if you have it or update it. Especially because it's currently in the California legislator. It's just not passed because California has just been dealing with a lot of stuff. So essentially, it's very similar to the Secure Care Act from Washington. If you don't have private long-term care insurance, you will have to pay a higher income tax. And that will go into a fund to potentially give you some coverage in your retirement. But you have to be living in that state, and your maximum coverage is like $30,000. It's very, very minimal. So they're essentially want to introduce that in California. It's already ready to be signed. They're just delaying it because of all the wildfires and COVID and all that. But that is something to watch out for. It is sitting in the the California legislator right now. The other insurance is disability. So this is a lot of those who work for corporate companies or any other employers, you probably do have disability insurance with they have it for you. So they have short-term disability and long-term disability. If you feel that that may not be enough coverage if in the time that you get disabled, people buy individual policies to make sure their income is replaced in the time that they're disabled. There's also Social Security. But if you don't have like a special needs condition, if you just are disabled, you can put the application in. And I always say you should give it a shot, but the acceptance rate is just getting lower and lower every day. It is very, very minimal to expect to get them to approve the Social Security disability. So that is something to consider when you're looking at all of your coverages. The last protection aspect is life insurance, and this is actually the meat of the insurance because it also can, depending on the life insurance you have, it can also, well, it's your legacy, but it also can be used as a investment, like a tax-free vehicle. And I'll explain the difference on this slide. So as you can see on the slide, there's two types of life insurance. There's term and there's permanent. Term is probably the life insurance you've come across. You have it for a certain period of time. So say 20 years, you have a 20-year policy. If something happens to you in that 20 years, your family or a trust or whoever you have it designated to will get the payment and, you'll be good. Now, if you outlive the policy, you won't get anything out of it. So that's why term insurance is the cheapest life insurance and it's meant for temporary coverage. So those with young kids, who and you have like a big mortgage, all that, you need more coverage, but it doesn't need to be forever. So that's where the term comes in. Permanent life insurance is essentially a life insurance that doesn't expire. So that's how people leave legacies for their next of kin. So, the questions that we had about, life insurance being put it into like, or, being dispersed into a special needs trust, all of that, that usually comes from permanent life insurance policy because this is a policy you can't outlive. This is a guaranteed legacy for your children or any next of kin. Now, there is an additional benefit to permanent life insurance. There is a cash value inside of it. And this is mostly your whole life. Your universal life is, I wouldn't recommend the cash value to use it just because it's there to extend out the term. But the whole life, as you can see, there's two types here. The cash value actually grows over time based off of the dividends that the insurance company gives, and your growth is tax-free. So it's a tax-free investment vehicle for you as well during your lifetime. So I'm sure some of you have come across the concept of a Roth IRA. This is very similar, but you get the life insurance and there's no limitations on how much you can put, how much you can earn, all of that stuff. So it's less limited. Plus you get the permanent life insurance that's the legacy you're leaving behind for your next of kin, especially if your next of kin is, someone who has a special need. Uh, this is something they would need. So yeah, it works as an investment for you and then it during your lifetime, and then it could be life insurance for, yeah. Um, so that kind of completes the protection section of the presentation. So that's why I know we did a little bit of a lot of content topics. So I wanted to stop for a few questions. I think there's some in the chat. So I'll stop for a few questions here. Let me see so okay,
So do we add a beneficiary on a checkings or a savings account?
yes, they will ask for one. Yes, you
And
can.
it's both, right?
Yeah.
Both
I mean,
separate.
usually they're linked, so if you put it on one, it'll automatically add it to the other one. Yeah.
Can you convert term life insurance to a permanent insurance?
Yes, you can. So you can if it's still active and you're still in that window, you can convert a term life to a permanent insurance. And the majority of the time you don't have to go through a health examination again. They just they just use your current age and then they convert however much you want into permanent and you'll be good. Any other questions? No? Oh, one more question I think popped up.
I had a question. What if you're older and you have never gotten life insurance? Because
So it's a good question. I do actually have older clients who do get life insurance for the first time. It is slightly more expensive, or it is going to be more expensive, and it also depends on health. Um, Now, if you're older and you're just uninsurable, you can't get life insurance. What we can do is possibly, maybe a spouse or, have it maybe written on the child or, something like that. So you can take advantage of the cash value. But it really just depends on, as long as you get approved, even if you're older, we can work around your budget. So, we can create a premium that still works for you. It's not going to be obviously like $25, I'm going to get
Right.
$500,000 in coverage. That's not going to happen, but we can still work around it. But the key thing is, are you still insurable? 80 is actually the cutoff to get life insurance. So
Hmm.
if you're younger than 80, that's like all across the board. Um, so yeah, as long as you're younger than 80, you do have a chance. But health is a big thing, so just something to keep in mind. Um, and then I think there's one more, or no, two more questions that popped up.
Um,
So
okay, so Cal Berkeley they're pitching me a Cal annuity and listing my family as beneficiaries. Thoughts on that?
So I don't know the specifics of the Cal annuity. I don't know, Michelle, if you're familiar with the specifics of the Cal annuity. Is that a government program or a Berkeley program? Who asked this question? Donald? He can ask it. He can unmute it and ask it. Is he here? Oh, it's a Berkeley program. Okay. So yeah, I don't know the specifics of the Cal annuity program. That would be something I'd have to essentially follow up. But if annuity specifically, that is a insurance product, but it works in reverse. So it's essentially, it's giving you a payment for your entire life. So it's benefiting you, not your next of kin. They ask you to put your family as beneficiary. So if you prematurely pass away before you put money, or the money that you put into the annuity runs out, they're not going to keep it. They're going to have to pay that to your family. So that's why they're asking for a beneficiary. It's called a charitable gift annuity. Oh, so you're buying an annuity for, I'm assuming, for somebody else. Well, this is,
Well,
yes.
I
Okay.
think I think Berkeley.
Yeah.
I think it, to be honest, I think it's out of the development office at Berkeley, and
Mhm.
it's a way that Berkeley makes money.
Oh, oh, so the beneficiary is Berkeley? Wow. Okay. Okay. Yeah, that's something, yeah, we
That's
can.
what I'm thinking. That's what, nonprofits do offer those charitable gift annuities where you get money in your lifetime, and then after you pass,
Mhm.
the nonprofit gets, I don't know, maybe a percentage or part of it.
Mhm.
Definitely look at all the fine print is
Yes,
all I could say.
definitely. And if you, Donald, if you want to talk offline, we can kind of go more in depth on that because it is a little bit more specific. Um, from Suzette, there are ads on TV about colonial life insurance for older people that doesn't require medical. Is this worth it? Okay, so any insurance company that says they don't require medical, um, either they're giving you so usually if they don't require medical, the coverage is very, very low. So if it's a low coverage and they're like, oh, you don't need a medical examination, that's completely normal. But if they're saying, oh, they're going to give you like more than 100 grand in coverage, and they do not requiring a medical, they're not going to look at anything. You have to be very, very careful because the majority of the time they will have a lot of exclusions on the policy. I can share a personal example with you. One of my clients had a policy with another insurance company. Unfortunately, we couldn't give her insurance because she had cancer. So when she unfortunately passed, and her mother thought the insurance from the other company will pay, but no, it did not pay because cancer was listed as a exclusion. So if they don't require a medical exam, you have to watch out for those exclusions. Yeah. Okay. So I know, just, in the essence of time, I'll go ahead and move on to the next section. Okay. All right. Just a nice little trivia. Where was the first US insurance company founded, and who had founded it? It was Ben Franklin, called the Philadelphia Contribution Ship. All right. So the next section, this is really the meat of your growth and your financial portfolio. So it's the accumulation. And you accumulate based off of the macro balance strategy. So it's both, you have to consider both risk mix and tax mix. We all consider risk mix. Like we don't always put our eggs in one basket in terms of, like how risky I want to be. But we miss out on the tax mix. And with everything that's happening, it does put disadvantage with taxes. So we'll talk about risk mix first because that is the most common, that is the most common thing. So when it comes to risk, you have variable assets and you have stable assets. So on the variable side, you essentially the value of the asset fluctuates until you actually sell it. So the more riskier, the more fluctuation, but the more chance of growth. The little bit more, safer. You have it's less fluctuations, but not as much growth. So examples of variable assets, your stocks, commodities, options, trade, stuff like that. So if you think of stock market, you're probably thinking variable asset. Now, a stable asset is something, the value of it remains fixed, and it usually pays some kind of fixed interest or a fixed dividend. So examples are bonds, cash equivalents, money market, guaranteed income, annuities, stuff like that. Those are your stable assets. You're guaranteed something, a dividend, a payment, or an interest, and you get it. So that's the difference there. Now, what's the right risk mix for you? You have to ask yourself three questions. How far are you from retirement or needing this money? I don't want to just say retirement because, we all have multiple goals that are not just retirement. So, how far are you from a certain goal? What is your risk tolerance? What are you comfortable with? And what are your money needs in the short term? So do you need a lot more money short term, or can you push it off, long term for retirement, etc.? So an example, if you're younger, like someone who's 25, they can take a little bit more, they don't need the money now. They have more time to retirement, so they can, put more in the variable, take more risk. So their risk mix may be 75-25 versus someone who is, in their mid 60s, their risk diversification may be 25 in the variable and 75 in the stable because they're actually using more of the money that they need. Tax mix, which is the aspect that is not considered as much. So we'll just do like the horizontal. You've got pre-tax and you have after-tax and you also have tax-free. So I'll point out those in the next slide. So essentially pre-tax, those are the majority of your traditional retirement accounts. So your employer 401ks, traditional IRAs, pension plans, deferred composition plans or compensation plans, 403Bs, you're taking the tax deduction today. So you essentially didn't even make that money today. That's what you're telling the IRS. And you're putting it into an account and then it grows tax deferred. And then when you pull out the money, you have to pay taxes on everything, on whatever you take out in that given year versus your after tax, that's both the money you put into the account is already taxed. So there's two now distinctions here. So you could put after tax money into a bank account, brokerage account, real estate, business ventures. Now, if you put it into those, if you make income or interest on these types of accounts, you have to pay the tax in that given year. If you use a Roth IRA or Roth 401k or municipal bonds and the cash value life insurance or the whole life insurance that we talked about, the money you put in has already been taxed, but all your growth is tax-free, and when you pull it out, it's tax-free. So to essentially make sure that have a good balance, you do want to have aspects of both the pre-tax and the after-tax, especially in retirement, because the pre-tax account, you could take the tax deduction today, so you're not writing a check off to the IRS today. So if you owe the IRS money, after all of your deductions, this is a good way to add another deduction. After tax, or the which falls the tax free, you do want to invest in that as well, because in your retirement, we don't know where taxes will be. You want to have accounts where you don't have to worry about what the taxes will be. You can just pull out lump sums and you're not taxed on it. So that way, you're not paying immense amount of taxes in your retirement, especially because in our retirement, the amount of deductions are less. So I guess, like, to sum up, like, you want to have like a full diversified financial house. So I'll stop really quick for questions here. I know I want to be, respective of time, but I think I saw one question in the chat. Oh, yeah, sure. That's fine. We can send this out, like a summary of this out in the follow-up.
Yep, I'll send out an email with Jennifer's slides to everyone tomorrow.
Perfect. I'll just go quickly through the last section, and then we'll stop for questions there, and then just wrap up. So the last section is just avoiding market pitfalls. So how to have your portfolio to make sure that you're not being victim of the market, which right now it is very, very relevant. So just a quick kind of FYI trivia question. The average annual return for the S&P 500 since its inception in 1926 through 2023, it has been 10.2%. So that's the average annual return. But that doesn't mean every year we have been getting 10.2%. So you'll see that in the next slide. So you see, like, you have it add the good years and the bad years, they kind of work in, well, they don't average out. Essentially, the good years outpace the bad years, so that you do get the growth. And you can see here, so when you do have a bad year, especially if you're not close to retirement, or you have a little bit of a longer time frame to reach a goal for a certain account, you can see here a bad year is usually followed by several good years. And the last kind of thing was 2022, before what we're currently going through. After 2022, 23 and 24 were great years. Now, with all the tariffs and the uncertainty, we have a little bit of market volatility, but everything essentially will cycle out. Now, how much?
Stay outside. That's in the driveway.
Now, how much you're invested in the market, or how aggressive, it should depend on, how soon you need that money, where you are in life, and how soon your retirement is. So, but just because we have a low year or we have a low day, you shouldn't pull out all your money. It would actually worsen your situation. And there's actually a very good example in that I will go over that kind of reiterates that point. But just to show in numbers, if you just did 9.38%, $10,000 from January 2003 to 2022, $10,000 should have grown to 64,844. Now, if you missed the 10 best days in that time frame, you halved that. And then if you missed the 40 best days, like, you actually lost money. So that's why it's not about timing the market, it's just being in the market for a long period of time to gain wealth. And it all depends on your time frame. And of course, the solution is to make sure you are correctly diversified, not just in variable and stable assets, but also in the market, you're diversified. And there's 4 things to consider, which I'll go over here. So when it comes to stocks, there are a couple of distinctions. Now you can read through this, but I'll kind of explain it in a more succinct way. So when you're investing in stocks, there's large and small cap. So large cap is going to be less volatile because those are your larger companies. Small cap is going to be smaller companies. You have chance for more growth, but you're going to see more volatility. You have growth stocks and you have value stocks. Growth, they don't generate really any income or dividends or anything like that. They're focused on growth. So you'll see more volatility versus value, it's more stable because the purpose of it is to give you a dividend or give you some kind of income. So those are they'll be more stable. And then of course you have foreign stocks as well, which has there is a what do you call it? There's opportunity there, but it is more riskier than domestic stock. So, and then the last thing you have to consider is sector. So you don't want to put all of your stocks into one industry or one sector. Because if that sector goes down, something happens, or tariffs are put onto this one industry, now all of your stocks have just gone down because you invested all in one sector. So all the aspects that I mentioned, you want to have a good mix of everything, and that's where a financial professional can help you. So even though you are maybe risky in the market, you're pretty spread out so that you don't see too much fluctuation. And then the last thing, which this example kind of goes into, is you're always supposed to buy low and sell high. And that's where this quick example comes in. And then I'll just kind of take questions and close out. So if you have three stocks, A, B, and C, you invested equally. After a certain period of time, A goes up, B stays the same, and C goes down. Usually people think like, oh, I'm just going to sell C and put into A. But you actually did the opposite of the golden rule of investing in the market. You are actually now selling low because you're selling C when it went down and buying high because A went up. So you did the opposite. So to optimize, you're supposed to actually, if you want to, you know, really do the buy low, sell high, you're supposed to sell some of A, put into C, balance it out, and you know, uh, go from there. So you just have to take the emotion out of the market. Honestly, the market does perform by a lot of emotions, but you have to take the emotion out, consult a financial professional, and also be in the market so that you see the growth and diversify yourself in the market. In with the five things that I mentioned previously. So with that, yeah, that's pretty much the content. I know I do have a little survey to fill out. I have it on a Google Sheet, Alexandra. I don't know if you want me to just put the link in the chat.
Yeah, that'd be great.
Okay, so if you guys can take a couple minutes to fill this out. Let me actually stop sharing so I
I
can.
can also send it out in the follow-up email.
Okay, perfect. I'll put in the chat for now in case some people can fill it out now. And then of course, yeah, and then you'll have it too. I just want to make sure this link actually no, wrong link, sorry. Hold on. 1 second.
Well, while you're doing that, Jennifer, I just want to say I have not heard this presentation before. We had looked at the slides, but this was really great. I mean, you really covered a lot in a very clear way. And it's complicated. A lot of the stuff is very complicated and hard to figure out. And, like even the example of the gentleman with the annuity from Berkeley, I mean, we had to do a little digging and like, oh yeah, Berkeley is the one
Mhm.
who's
Uh,
gonna, benefit.
Yeah, no, I appreciate you setting this up, Michelle and Alexandra, and thank you so much, everyone, for your time. I will take us a few more questions, but also anyone, if it's okay with you, obviously, Alexandra and Michelle, if anyone who listens to this presentation, I always just let them know that you can do a complimentary personal session with me if you'd like to. But of course, if Michelle and Alexandra, if you guys are okay with it. So if you do want to do, is that okay, Alexandra?
Of
Okay.
course, yeah, no, that's amazing.
So yeah, if you want to do a personal one-on-one educational session with me as well, you can obviously fill out the survey. It will ask you a question there, and then you can just put your contact details, and I'll just reach out to set up a time. But any other, questions? For based off of some of the thing. I know at the end it got a little tricky, but I did want to, be cognizant of everybody's time.
Well, one question, Jennifer. They say that bonds and stocks almost always have that inverse relationship. Do you think that still holds true even with all the craziness we're seeing?
Not necessarily, because the bonds are down too at this point.
Right.
And it's usually bond rates and interest rates are inverse.
Hmm.
That's usually the thing, not bonds and the
Oh, okay.
stocks. Yeah. And in terms of bonds, investing in bonds, it is safe. But, since the turn of the century, the rates on those have been very low. So it might be, good to kind of look at other options like, life insurance, where they're giving you a higher interest rate or a dividend rate, or any like fixed products that are giving you a higher interest rate than putting into bond. Because bond is like, yeah, it is because it's not fixed. You could still lose in a bond. The
Right.
value of the bond can go down. So, and the interest rate is very low. Other fixed assets are a better alternative, especially in this century. Yeah, yeah. Any other questions? No?
Thank you
Does
so much, Jennifer.
Okay, no worries. Does the
Yeah,
link
this was
work?
great. Thank you.
Quick question. Does the link work?
Yeah, I just tried it. The second
Okay,
link worked. Yeah.
okay, perfect. Perfect. But yes, I would greatly appreciate you guys filling out the survey just for, seeing how I did. And I appreciate all of your guys' time.
Thank you.
Happy Memorial Weekend.
All right. Thank you so much.